If I had to start putting money to work today from scratch, knowing what I know about this historic rally, the oil risk still lurking under the floorboards, and the earnings avalanche that's about to hit over the next 2 weeks, I would do one thing very differently. I would stop thinking like a chaser and start thinking like a planner. Because that's what this market is demanding now. This is not a lazy grind higher where you can close your eyes and buy whatever ticker your cousin texted you. This is one of those rare stretches where price is screaming confidence, headlines are whispering danger, and the real money is usually made by the people who can sit calmly in the middle of both. Today is Monday, April 20th in New York, so comment the day and date you're watching from down below. And if you value this kind of content, subscribe and comment John A.G. Best, so I know you want more of these market breakdowns. Now, I want to be really clear because this is where people get themselves into trouble. I'm not telling you to panic. I'm not telling you to chase. I'm not telling you to pretend the market can only go one way from here. What I am telling you is that when you get a run this sharp, this fast, and this clean on the surface, the next mistake people make is almost always the same. They confuse momentum with safety. They start believing that because the tape has been forgiving, it will stay forgiving. They stop paying attention to what could interrupt the move. And then when something finally does, they act surprised, like gravity just got invented yesterday. Because based on recently published market data, the tech-heavy index just logged a winning streak that ranks among the strongest this century, while the benchmark index has already pushed back to record territory. Reuters reported the Nasdaq reached a record finish only days after it had confirmed a correction, which is not normal behavior. That kind of snapback tells you buyers were aggressive, underexposed, and very willing to press the gas once the headlines softened. It also tells you the easy part of the rebound may already be behind us. And this is where the story gets interesting, because underneath that strength, the biggest unresolved macro problem has not actually gone away. Oil cooled from its panic spike, yes. The Strait of Hormuz reopened for a minute, yes. The market breathed out, yes. But then the weekend happened, a U.S. ship seizure hit the tape, tanker traffic got messy again, Tehran signaled it would not rejoin more talks, and crude shot right back higher. Reuters, the Associated Press, and other outlets all reported renewed fears over the strait and a fresh jump in oil. So when people say the geopolitical story is over, I don't think that's serious analysis. I think that's relief pretending to be certainty. And why does that matter? Because oil is not just a commodity here. It's the pressure valve. If crude calms down and keeps drifting lower, inflation nerves ease, yields can settle, and stocks get more room to digest their gains like adults. But if crude stays elevated or starts moving toward the mid-90s again and holds there, then the market has to deal with the thing it has been trying not to deal with. More fuel costs, more margin pressure, more inflation uncertainty, more questions about what the Fed can and cannot do. That's when this beautiful little rally suddenly has to prove it deserves the valuation it just reclaimed. Now, here's the part that I think a lot of traders are going to miss. A pullback from here would not automatically break the larger bullish case. In fact, it might actually strengthen it. One of the oldest mistakes in the market is assuming that a sharp drop after a vertical move means the whole thesis was fake. Sometimes that's true. Sometimes it is absolutely not true. Sometimes a market rips because it was too negative, then pulls back because it got too excited, and then resumes because the larger setup still works. That middle shakeout is where people either make their year or ruin it, and there is a real historical argument for not panicking if that shakeout shows up. The competitor outline you gave was leaning heavily on midterm year behavior, and once I checked the broader setup, the spirit of that argument still holds up better than most people probably expect. This year already delivered a meaningful scare, then an almost violent recovery. When that kind of fear gets compressed and then released, the following 12 months can end up stronger than the mood in the room would suggest. That is not a promise. It's not magic. It's just the kind of market behavior that tends to happen when positioning, policy anxiety, and headline fear all get flushed in the same cycle. But I do want to push back on one thing. I don't buy the idea that every dip from here is automatically a gift from heaven. That's too easy. Some of this move is clearly being driven by fundamentals, yes, but some of it also looks like a positioning squeeze. Reuters reported U.S. equity funds kept taking in money on hopes of de-escalation, and another Reuters piece described a revival of the "there is no alternative" trade back into U.S. stocks. That tells me some buyers are enthusiastic because they want exposure, not necessarily because everything is cheap. Those are not the same thing, and you really don't want to learn that lesson with a full-size position bought at the wrong moment. So what is the next real test? It is earnings, plain and simple. Nearly a fifth of the benchmark index is expected to report this week, and Tesla is scheduled for April 22nd. Alphabet follows next week, and then more of the mega-cap heavyweights start coming in right after. This is the point where the market stops trading on hope and starts trading on scoreboards. If the numbers are solid, if guidance stays healthy, if management teams do not sound spooked by energy costs and demand, then the bullish side keeps its case. If guidance slips and the market starts shrugging at good reports, that is when I would get more defensive. The good news for the bulls is that the earnings backdrop is not weak. FactSet's latest update says the blended earnings growth rate for the first quarter is sitting in the low teens, with double-digit growth on track for yet another quarter. It also shows the biggest technology names are still expected to contribute a meaningful share of that growth, while revenue growth for the broader index is running in the mid-single digits. That is not the backdrop of a market that has no fundamental support at all. Could it cool? Sure. Could guidance disappoint? Absolutely. But the starting point is stronger than the doom crowd would like you to believe. And then you've got the chip story, which really matters because it tells you whether the artificial intelligence spending engine is still alive. Reuters reported last week that both TSMC and ASML lifted their outlooks, with TSMC citing very strong AI-related demand and increased capital spending. That's a big deal. It means the market's favorite secular theme did not just vanish because the macro tape got noisy. It means the demand chain still has fuel in it. So when I hear people say the growth trade is all smoke and mirrors, I think that's too simplistic. Parts of it may be overheated, yes, but the backbone is still there. There's another reason I'm not eager to call the top, just because the chart looks stretched. Under the surface, participation has actually improved. Reuters noted that advancing stocks were outpacing decliners on the Nasdaq during the push to records, and software shares have been leading parts of the rebound after getting hammered earlier in the year. On top of that, buybacks are still part of the support story. Reuters reported that U.S.-listed software companies had already authorized tens of billions of dollars in repurchases since January, which means there is still a corporate bid sitting under selected names if results hold together. That doesn't mean breadth is perfect, and it doesn't mean every battered stock deserves forgiveness. It means this rally has more than one engine, and markets with more than one engine are usually harder to kill than the crowd expects. Now let's talk about valuation, because this is where I stop getting casual. The broad market is not exactly cheap again. After a rebound like this, you're not shopping in the clearance aisle anymore. You're paying up for quality, momentum, or both. That doesn't mean you can't buy. It means you need to know what you're buying and why. This is not the kind of tape where you throw money at every ticker with a nice chart and hope the market carries you. That phase was easier earlier. Now we're in the phase where selection matters more, entry matters more, and patience matters a lot more. So if I were building the roadmap right now, this is how I'd think about it. First, I would stop obsessing over whether the market is going to crash tomorrow morning. Nobody knows that. Nobody. Anybody pretending they know the exact next headline out of Tehran, Washington, or the shipping lanes is selling confidence, not insight. The better question is this. If the market finally gives me a real reset because oil spikes, talks stall, or earnings create a temporary air pocket, what do I actually want to own when that fear shows up? That is the question that matters. For investors, I still think the growth-heavy index deserves a central place on the watch list, not because every single name inside it is perfectly priced, not because risk disappeared, but because when the market decides the larger path is still higher, that is usually where the disproportionate upside shows up. That's where liquidity rushes. That's where performance chasers go. That's where narrative strength can matter the most. If we get a flush and the larger thesis stays intact, that is probably where I would want the heaviest exposure. For stock pickers, I would stay focused on selective software, selective semiconductors, and only a few higher beta names where the setup actually earns the risk. A lot of software still has room to recover if results come in better than feared. The semiconductor space still has structural support from AI spending. And then you have the more explosive names, the ones traders love because they can move a week's worth of percentage points in a day and a half. Those can absolutely work in a risk-on tape. They can also punch holes in your account if you size them like a lunatic. So be honest about what kind of player you are. For traders, I think the opportunity set may actually be better than the investor opportunity set in the very short term. A volatility pop on scary headlines that does not break market structure, that can be tradable. An oil spike that turns emotional without a real supply shock getting worse, that can be tradable. A mega cap earnings report where the options market prices in a dramatic move and the stock just kind of wiggles around, that can be tradable too. But I'd say this carefully. If you don't really understand the structure of the trade, you do not have a trade. You have a guest wearing a costume. And this is the mindset shift I want people to make. The market can be right on the bigger direction and wrong on the immediate path at the same time. We could still be looking at a solid next 12 months and a very annoying next 4 weeks. Those two ideas can live together. The stronger the rebound, the more likely it is that we chop, fake people out, and test who actually has a plan. That's normal. What would bother me more is not a red day or even a red week. What would bother me is a renewed oil surge, weaker guidance from important leaders, and a market that stops rewarding good numbers. That combination would tell you the character is shifting. Also, do not ignore policy. Kevin Warsh is set for a Senate hearing on April 21st as President Trump's Fed chair nominee, and the clock is ticking toward the end of Jerome Powell's term as chair in mid-May. Reuters reported both the hearing date and the uncertainty around the leadership transition. Markets are going to listen. Maybe not because one hearing decides everything overnight, but because investors are trying to figure out whether monetary policy could get more politically complicated, right when energy prices are already creating inflation stress. That is not some side plot. That's part of the setup. So when I step back from all of this, here's my honest read. The rally is real. The strength is real. Some of the earnings support is real. The AI spending backbone still looks real. But the unresolved oil story is real too. The geopolitical uncertainty is real. The market's tendency to get ahead of itself after a streak like this is real. And the best posture, in my view, is neither fear nor blind excitement. It is prepared patience. Let the next wobble come to you. Let earnings separate the strong from the weak. Let oil tell you whether the inflation scare is cooling or coming back. And if we do get the kind of pullback that shakes out the tourists and scares the late chasers, don't freeze. That's what most people do. They say they need one more red day, one more confirmation, one more headline. Then the market turns without them. And suddenly the thing that looked risky in the moment becomes obvious in hindsight. It is never obvious in the moment. That's why it pays. If you're successful, share your success story in the comments so others can stay motivated. That's why discipline matters more now than optimism or fear. So no, I would not blindly chase this market after a historic run. And no, I would not assume the opportunity is gone just because the easy bounce already happened. I think the smarter play is to respect the rally, respect the risk, and be ready for a better entry if headlines, oil, or earnings hand it to you. Because if that reset comes and the bigger thesis still holds, this could turn into one of those rare windows people talk about long after the panic is forgotten. And just so we're crystal clear, this video is for education and market perspective only. It's not personal financial advice, it's not a promise, and you should make decisions that match your own risk, your own time horizon, and your own life.